Blake, thanks for joining us. It's great to have you here at NASDAQ. Obviously, been an insightful and lively couple of days of discussions, but maybe just to kick us off, can you just give us a quick introduction to Formentera Partners, sort of how long you've been around, just for those who aren't familiar with the firm. So sort of how long we've been going, just a quick overview of current exposure, assets under management, asset classes that you're focused on, and sort of geographical focus areas.
Oh, thanks for having me. So Formentera Partners was started a little over 3 years ago. Myself and Brian Sheffield, after the exit of Parsley through the sale to Pioneer, teamed up to form a real asset private equity firm with a little different approach than traditional private equity. We've raised about $1.4 billion under management to date. We're invested predominantly in the U.S. on buying direct model, meaning we're the operator. We're not backing portfolio company management teams, upstream oil and gas properties where we're the operator. And we're managing those properties for an income-like model approach and strategically developing those assets when it makes sense. And so to date, we've deployed majority of our capital in the U.S. across 6 states. We own and operate through over 200 employees. We also have an investment in Australia, which is a little different than our traditional model in the U.S., where we're focused on more of an exploration gas shale play with LNG upside. And so it's obviously been a whirlwind over the last couple of years, but feel confident that there's a real opportunity to keep buying direct operated model assets in the U.S. on a cash flow based approach, and then developing when the price is right.
Amazing. And you've alluded to it there, sort of the direct operated model that you run. Can you explain the thesis behind the model? Sort of how does that work, and why does it set you apart from traditional energy private equity firms?
So obviously there's been a lot of oil and gas private equity over the last 20 years, with most of it focused on more of the venture type model, which is I back a team, we build an asset in a company, and then you build it and then try to sell it to the next buyer. We at Formentera saw an opportunity where, if you are able to break down the cost model of the double promote of traditional private equity, you'd create this opportunity set that's a little bit different, that you could target a different kind of risk adjusted return model, where if you are the operator, you can control your own destiny in terms of operations, in terms of management of that cost, where you can target more of a yield-oriented asset class that most of traditional private equity can't target. And so I think as we thought about the combination of, my partner's background being the operator, having built Parsley, with my more traditional finance background, was a good pairing to figure out how to go about, owning and operating assets together in a more cost-efficient format versus traditional private equity.
Okay, awesome. And I think obviously a trend we've seen over the last couple of days inevitably is around consolidation and the activity that we've seen over the past 6 to 9 months or so. We hear a lot about sort of the public companies battling for scale and relevancy in the public markets. What opportunities do you see starting to present themselves for a firm like Formentera off the back of this wave of consolidation, and maybe some of the smaller or independent players in the market?
So it's clear that public consolidation has picked up and probably will continue to do so as the large guys want to get bigger and rationalize their portfolios. And so on the back of that, you're going to see a lot of non-core assets that obviously a lot of this consolidation has been focused on certain regions that they're buying that are good fits for their current portfolio. And so I think what's going to result in this large public consolidation is a huge wave of non-core asset sales. That's going to be perfect for firms like Formentera or other private equity buyers that are looking to kind of buy the pieces of non-core assets where they can focus and figure out how to create value in the near term, whereas some of the larger publics are obviously, it's very further out in their development schedule, and so they're not as focused on it. So it's a logical opportunity of passing that asset base on to the next private buyer.
Okay, awesome. And another theme that's popped up over the past couple of days is that around resource scarcity and how operators are building a future runway and a longer runway of as obviously reservoirs start depleting and so on and so forth. So with this recent upstream M&A activity, will it lead to tier 2 rock becoming the new tier 1? Where are the best opportunities for investors like yourselves to access quality development activity?
So there's no question that the theme of core tier 1 inventory depletion is very pronounced in the market. And I think the public consolidation is a way for the remaining operators to figure out how to acquire that core inventory to expand that runway for as long as possible. I think the consolidation itself doesn't lead to tier 2 becoming tier 1, but what it does do is as the remaining tier 1 inventory is consolidated into the larger players, and the acceleration of that development of that tier 1 results in, probably the need for tier 2 to step up, whether that's through technology or prices being higher. where it can be a backfill of the resource needed in the U.S. and globally to fill the supply-demand imbalance that's likely to occur as a result of the underinvestment. So there's no question. It's unclear on, is it 3 years, 5 years, 7 years in terms of remaining tier one inventory. But what is clear is that the need for tier two is going to become more pronounced over time, and that, through the need of higher prices or, 3-mile or full-mile laterals or technology evolution is going to result in tier one likely becoming a tier one property.
Okay, no, that's great. And just finally then, I want to touch on the election. Obviously, it's an election year, has different potential implications depending which way it goes. We've obviously seen over the past couple of years, investors really wanting the industry to prioritize generating free cash flow, capital discipline, operating discipline. How do you see the potential outcomes of this year's election impacting investor appetite and confidence in the oil and gas industry? And how could the differing potential outcomes impact, say, drilling activity as we look ahead to 2025 and beyond?
Well, it's always a great question, and you always hope to have the crystal ball. What I would say is that if you look back over the last several election cycles, it's clear that Democratic administrations have resulted in better performance and higher prices for oil and gas, and a lot of that has to do with more energy regulation and policy lead to higher prices, and that in Republican administrations over the past, the ability to drive incentives for drilling has resulted in prices being lower. Whether that was 16 through 20, clearly oil prices were lower. Now, I think this election, in my view, and again, I don't have a perfect crystal ball, is I think there's probably a little bit of indifference in terms of the true impact, meaning, one of the reasons why the switchover from a Democratic to a Republican administration in 16, resulted in prices probably going lower is because of the availability of capital in the public markets, and the model still being growth oriented resulted in significant pickups in drilling activity, which resulted in lower prices. I think what's clear and what is here to stay, in my view, is that there's been a clear shift in business model, largely led by the publics, that's now moving to the private side, which is capital discipline, return of capital, and not outspending and focused on growth is the clear theme that has rewarded publics in terms of share prices and performance and incentives for management teams. And so, regardless of the outcome of the election, you could argue that if it's a Democratic, administration, energy policy will continue to be more regulated and probably higher cost. It will probably be a little less regulated and a little easier in a Republican administration. And so you could argue maybe a little bit of price degradation and drilling activity picking up a little bit in a Republican kind of outcome. But I think at this time, the impact of the lack of capital and mostly from the change in business model is kind of here to be more permanent. And until that changes, I don't think the ultimate winner of the election is going to lead to a dramatic price movement one way or the other.
Okay, well, we'll keep an eye on it and see how it plays out. But
Yeah.
Blake, appreciate you sort of taking the time to speak, and good to see you here at NASDAQ, and look forward to keeping in touch.
Absolutely, appreciate it.